Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here is what we're watching at this hour. First up, the AI trade still coming under pressure. We're going to dig into the sell-off and whether more pain is coming. Plus, we'll gauge the health of the consumer as Home Depot slashes its earnings outlook. And we'll look at how to position your portfolio for the rest of the year with the founder of Tiger 21. It's a network for ultra high net worth individuals. Where are they putting their money? We shall tell you. But let's take a look at the major averages right now because we are seeing this sell-off deepen and continue here for the major averages and especially for technology. The Dow right now down more than 450 points, about 1%. The S&P 500 down about 1% as well. The NASDAQ leading declines here. It's off by 1.5%. So this is the year-to-date move for the NASDAQ here and this sell-off that we've been seeing as of late. How big is it? Well, let's take a look at it for the 1 month basis here. So you see here the sell-off that we have had basically since the end of October when we saw the peak for the NASDAQ. If you shorten it to 5 days, you see a sell-off of more than 4.7%. What are the catalysts here today as far as we can tell? It looks like it is mostly sentiment-based. We had a downgrade coming from Redburn from an analyst for a couple of the big tech names. We had the CEO of Alphabet coming out and saying, yes, there are areas of the market here that might be a little bit overvalued or might be speculative. And we see that if we look at some of the individual names here, we see at least the sentiment continuing to sour within large cap technology. NVIDIA today down 3.4%. Remember, it reports after the close on Wednesday. Amazon down 4% today. Microsoft down 2% today. Meta down 2.5% today. Then you have some of the smaller but still very large companies like AMD, which is down by 6%. AMAT down by 3%. You get the idea. We are seeing this broad-based sell-off. If you equal weight the NASDAQ 100, it looks a little bit more equal here, but when you have those large cap tech giants that are so heavily weighted here and they are down so much, obviously that drags the whole thing down. You can also look at the sectors here and you see the same situation. Consumer discretionary as well as the XLK, which is tech, are doing the worst. Consumer staples and healthcare are up today. You look at some of the sort of momentum leading indicators here. The SOX, which tracks semiconductors, is down. Solar stocks are down. The Mag 7 is down. ARC is down. So you get the idea. Quantum coming off the boil as it has of late. So you see the things that had been momentum up are now really fading, and that has been the trend as of late. So let's talk more about this trend, because amidst the sell-off in big tech, analysts, they've mostly stayed pat. There is one exception this morning. Amazon and Microsoft were downgraded to neutral by a Redburn analyst. He says the bull case for generative AI is, quote, no longer clear. So let's ask a veteran tech investor if he has any qualms. With us is Paul Meeks, Freedom Capital Markets Managing Director. Paul, it's great to see you this morning. So we have that analyst come out and say, maybe generative AI is not all it's cracked up to be. The market seems to be saying that to some extent, or at least is asking questions, right, as expressed through the selling. What do you think?
I think that particular call is just chasing the market down and then coming up with a fundamental reason after the fact. I feel pretty comfortable with 2026 AI infrastructure build. I don't think that it's going to collapse in 2027. And so the folks that are supplying the picks and shovels and axes, I think they're going to do very well. And I think that tomorrow, when NVIDIA reports and gives their guide, Jensen Huang, as he always does, is going to make us feel good about NVIDIA's prospects and the rest of the industry. And I think we'll probably get some kind of a relief rally in some of these names because they have imploded, as you said, not since October, but even in the last week or two. And so I think it's going to shape up for a better buying opportunity. I don't know when the correction ends. Nobody knows that. I've gone from being a fundamental analyst to a technical analyst. But when some of my favorite AI infrastructure stocks settle on low volume and the selling looks exhausted, I'm going to buy them with both hands.
Paul, at the same time, I was looking through some of the commentary in the Bank of America monthly fund manager survey, and one of their findings is that it's the first time in 20 years that investors say companies are over investing, right? So even if you believe in the infrastructure play that spending will continue, at what point has it gone too far? And at what point has it maybe extended to the further reaches of the universe, if you will, and maybe that there are some players that have become overextended?
There's always that situation, right? You can never shotgun shoot these things. You have to be more targeted with rifle shots. But I don't think that the spending is going to be curtailed for quite a while. Now, at the end of the day, do we have to monetize, not in a little way, but in a big way, some of these apps? Of course. But I don't expect to even have to make that call for longer than my investment horizon for some of these stocks to double quickly off their bottoms.
So what are your candidates for stocks that might be doubling quickly off their bottoms here, Paul?
You know, I think CoreWeave and Nebius, which are two neo clouds. CoreWeave, for example, last week announces results. Their guide is 3% lower for revenue for 25. And since then, their stock's down about 30%. So I think that's a gross overreaction. And so the neo clouds and some of the neo cloud adjacents look interesting to me. And even mighty NVIDIA, I think it actually is now trading well under 30 times, actually a PE ratio, not that much higher for next year's earnings than the S&P 500. And I think we're going to do great there. It's just an overreaction. And of course, the sell side analysts typically, when stocks are falling, nobody has the courage to step up and go contrarian. I'm doing that today.
And in terms of NVIDIA, right, even when it has come out in recent quarters and beat, and it has mostly beat, the stock has frequently fallen. Do you think that right. It's at risk of doing that again? Or do you think because we've been selling off in advance of the report, it's sort of better positioned this round?
I think it's better positioned this round, but who knows what happens. You know, we also have a bit of an obstacle that now it doesn't look like a slam dunk on December 10th that the Fed is going to lower rates, which we really need to propel these aggressive growth in other tech stocks. But I think NVIDIA has come down so sharply with all this commentary and lack of support of that company and others by the street that I would expect a relief rally the day after tomorrow.
Paul, there's some breaking news that I want to ask you about on this subject of NVIDIA. And we've got yet another partnership, but this one doesn't involve OpenAI. It actually involves Anthropic. So NVIDIA is going to invest $10 billion in Anthropic. Microsoft is going to invest up to $5 billion in Anthropic. And Anthropic, in turn, is committing to buy $30 billion worth of compute capacity, Azure compute capacity from Microsoft. Now, we've seen these deals usually with OpenAI at the center, but it seems like everybody's got a deal right now. Is it just like sort of, this does not feel like a rifle approach when it comes to these companies investing each other. It does feel like flooding the zone, to mix my metaphors. What do you make of this latest one?
Well, I think it's an incremental positive, and at least we're getting away somewhat from the codependency on OpenAI. But there is no doubt we have a very intricate web of interrelationships between these companies, because you think about Anthropic in particular, one of its biggest shareholders is Amazon. Right. And now they're doing deals with Microsoft Azure. You'll expect this to continue, but I will tell you this. I feel pretty good about the spending for the next couple of years because 90% of it is coming from the hyperscalers who have the finances to do it easily. And B, all of the CEOs of these big spenders are seeing this as early and heavy spending on AI infrastructure as critical to their competitive advantage. And when you get guys like Mark Zuckerberg saying this, you know, the most ruthless guy on the planet Earth, I believe they're going to spend the dough.
I love that characterization of Mark Zuckerberg. Paul, finally, I want to ask you, we're going to talk to Wall Street Journal columnist Greg Ip in the next hour. And he was out with a column today where he said, if you're in the market right now and you've been investing in these names, you're doing great, even with the sell-off recently. But the sentiment around AI is pretty lousy from normal people. They're scared it's going to take away their jobs. There's a lot of uncertainty. And that past cycles haven't necessarily been like this in terms of the trepidation around this innovation. Is that going to be a curb on it ultimately?
I don't know if it'll be a curb on it, but as far as the anxiety that is impacting the common guy, yeah, I think that continues. But what will happen is with most technology transitions over the history of time, what happens is, yes, some people lose their jobs, some people find jobs, but overall, people become wealthier. And when they become wealthier, they spend more. So at least indirectly, that propels the economy.
Yeah, we'll see how it works out this time around. Paul, thank you so much.
Thank you.
Home Depot reporting a third quarter miss as consumers pull back. We're going to dive deeper into those results next on Market Catalysts. Home Depot is falling after it missed third quarter earnings estimates and cut its full year guidance. Consumers pulling back on home improvement projects. Joining me now is Joe Feldman, Telsey Advisory Group Senior Managing Director. Joe, good to see you. So we got these numbers. They weren't great. What are your sort of high level takeaways?
Yeah, it was definitely disappointing. And I think some of it was related to the setup. Last quarter, Home Depot got a bit more positive about the trends. And they were seeing better trends, but they felt the second half was going to be a bit stronger. And come into the third quarter, there was a lack of storms, as unfortunately for most of the country, hurricanes are bad. But when they do happen, they're good for Home Depot. And that didn't happen this year. We were comparing against a couple of hurricanes. So that was really a big part of the driver. They just spoke on the earnings conference call about really having an underlying sales trend of probably about a 1% comp for the quarter, similar to what you had in the second quarter. Like I said, I think they just got a little too optimistic about how this was going to look. If you look at how the stock's reacting, it's kind of down about as much as they adjusted their guidance for the year in terms of EPS, down 3% more, and that's kind of where the stock is. So I think the market's taking it in stride. They just want to see improving trends.
Well, where are those improving trends going to come from, Joe? Because the housing market is not really improving, and you would think that people who are still in their homes with the homes worth more would then have some equity to do repairs, but it doesn't really seem to be playing out that way.
Yeah, no, we still are seeing that kind of delay in that big ticket, big project spending. Big ticket spending has actually been up. People are replacing appliances, power tools, or doing small projects within the home. So that demand is still there. I think that for people to really start to engage in larger ticket, big activity, maybe with rates coming down a little bit more, with a couple more rate cuts in the next half a year or so, that would help. I do think that affordability is still an issue for people to buy homes, but we are finally seeing housing turnover level off around this like 4 million level. In its heyday, it was running around 5 million a month. So, or at an annual rate. So now that you're at this 4, you want to see that pick up a little bit, but the core homeowner is not moving all the time. So to your point, you really want to see people investing in their homes. And so long as they're feeling good about the equity that they have, which has grown significantly since COVID, if interest rates can come down, making borrowing a little bit more appealing, that might show some investment back into some bigger projects.
And Joe, I'm curious what's going on the pricing front. I know that Home Depot, because they had a lot of inventory already pre-tariffs, that they haven't raised prices, but are those price increases coming? And does that then put some additional pressure on them?
Well, we do think price increases across the board, just in retail in general, are going to pressure consumers. What's a favorable tailwind to offset some of that is with the fourth quarter, it is a promotional period, so promotions will have to offset that. You get into the first half of next year, tax refunds should be higher. People have probably been over withholding given the new tax bill that was passed this year, so that should start to help. But we've seen prices starting to flow through at a higher level. Home Depot did talk about it. They felt it was a little early to see much impact in terms of the elasticity. And it's only half their business because half of what they buy really does come from the U.S. But still, they're pushing through some price increases. I think we're going to hear about it the rest of this week from others like Lowe's and Target, Walmart, and these price increases across retailer are happening for real. And I think it is going to be a bit of a headwind going into next year, again, offset by some of those tailwinds I mentioned.
And so what does that imply also then for the other companies we're going to hear from this week, some of which you just mentioned, you know, the Lowe's, the Walmarts, then the Targets of the world. Is this shaping up to be a tough time for many of them?
I think that we're going to hear probably something similar from Lowe's tomorrow in terms of pressure on the consumer. Now, expectations weren't as high going in for Lowe's, and people have been taking numbers down recently. Target has still been a bit of a challenge. Walmart really wins in this environment. People are seeking value, and when they do, that definitely benefits a Walmart because that's the place people go first. So I think we're going to hear at the end of the week, with all these puts and takes that I just mentioned, I think you're going to still see a consumer that's somewhat resilient. The upper end is still okay, spending, it's still very much a K-shaped economy. That lower income, there's an additional pressure that's happening. You're going to hear about a more pronounced paycheck cycle, I think, when we hear from Walmart and from Target. So all of that combines to probably leave us in the same place. When you mush it all together into the grinder, you're probably still seeing consumer spending up a little bit for the holiday season and people still getting gifts. And at the same time, there's still caution around how much they are spending and really focusing on value.
And are people going to be spending less overall over the holidays?
You know, the forecast that we have for now is to be up 3.5% to 4.5%, which is a little wider than our normal range, mainly because of the uncertainty, price increases because of tariffs and such. But we've seen a lot of other estimates out there. The NRF, I think, is right around 4%, and other groups have done around the same. A lot of that's probably inflation driven, to be perfectly honest. You know, when you look at the units, it's probably flat, maybe slightly down. So I think the spending will look okay. That's the thing. It's like, but the way people feel may not reflect truly in how the spending will come out. So that's why we have this really mixed bag here. The sentiment is not great, and yet the spending numbers will probably look okay.
Yeah. All right. Well, we'll be watching all of that, John. We'll check back in with you. Thank you.
Thank you.
Former Federal Reserve Vice Chair Lael Brainard joined Yahoo Finance Invest to discuss the Fed's path forward. Here's part of that interview with our Brian Sozzi.
Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now, and it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data, and both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys, whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So, look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed El-Erian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those 2 risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
Coming up next, we'll get you checked out for trending tickers, including yet another OpenAI partnership. We'll be right back. Now time for some of today's trending tickers. We are watching Kroger, Intuit, and Amazon. First up is Kroger. The grocer announcing a shift in its digital strategy that will result in a $2.6 billion impairment charge. The company will close some of its e-commerce fulfillment centers and expand partnerships with delivery companies. Kroger's interim CEO says these efforts will help the grocer deliver profitable sales growth, and the shares are up almost 2%. Next is Intuit. The company behind TurboTax will spend more than $100 million on a multi-year contract with OpenAI. Intuit looking to bring the ChatGPT maker's AI models into its financial apps. In addition to the new spending commitment, Intuit will offer applications inside ChatGPT that will let users access and to interact with financial data stored within Intuit's platform. Those shares up about 1%. And finally, Amazon, the company's Zoox robo-taxi service is rolling out in San Francisco. Zoox is taking on Alphabet's Waymo, which already offers driverless rides in that city. Riders can sign up to join the Zoox Explorers program to take free rides in the company's box-shaped vehicles. Zoox notched a major milestone in September when it opened up its robo-taxi service to the public for the first time in Las Vegas. The company is offering free rides while it waits to get regulatory approval for a paid service. But of course, those shares are down with the downdraft in tech today. Coming up, we're taking a deep dive into the Fintech space where you can find opportunities in that sector. That's next on Market Catalysts.
Welcome to Goodbye or Goodbye. Our goal here is to help cut through that noise to navigate the best moves for your portfolio. I'm here now with Infinity VC, venture partner and capital VC, founder and managing partner, Cameron Ansari. Cameron, great to see you, my friend, as always.
All right, good to be here.
We're going to go through what you like and what you don't like so much. We're going to start on what you like, and this is SoFi. Now, this one, it's had a nice move already, Cameron. This one is up more than 70% year to date. Most analysts have a hold on this one. Not you, Cameron. You say this one's a buy. Let's go through some reasons why. First one, business diversification.
Yeah, look, this is a company that SoFi, I think, stands for social finance. I think when it first started, it was in the student loan refinancing and kind of in the Facebook era. And it's branched out now to a full service bank. They offer lending, they offer investing products, they offer a checking and savings account, mortgages. So now they have multiple business lines, and in fact, I think as of the last quarter, the business lines other than lending make up more than half the revenue, which is very impressive.
Second reason you say you like this one, benefit from lower rates.
That's right. Look, like all lending businesses, the lower rate environment as the Fed starts to move the rates down is going to help them, particularly with their mortgage and student loan refinancing business. Mm-hmm. So I think that's going to be a nice tailwind for them and going to continue the momentum for the business.
What if I said, Cameron, I said, I'm listening to Fed, man, and some of these central bankers, they seem kind of nervous about that inflation. I don't know if you're going to get that cut in December.
I agree. Look, I think it's... I think people are expecting a cut, but we'll see if that happens. I think they already did cut it once, maybe twice. So we've had a little bit of a trickle down. But if anything, it's going to stabilize, right? It's probably not going to go up, which I think is going to benefit to the business.
Third reason, you say this one is smart to commit capital to higher profits.
Oh, they're really doing very, very well in the profit line. They're about 25% EBITDA margin. They're growing 30-40% year on year for a business of this size. They're at about $3.5 to $4 billion of top line. To grow 30-40% annually is quite impressive. So I think the profits, the revenue growth, I think that's the story here.
All right, so you made a convincing case, Cameron,
Yeah.
as you always do. Before I commit capital, though, let's walk some viewers through what are the downside risks I should have on my radar.
I mean, this is really it, right? The upside, it's already been up, I think, about 100% this year. Excluding today. Today's obviously been a little bit of a bloodbath across the whole market, but. This stock has a lot of gains that have already happened, and it's trading at a premium in terms of multiple to things like PayPal and Square and others. So, the hesitation might be, look, has the upside already been built in? How much is left from here? But the business looks like it's quite, on a roll. Anthony Noto, the team is fantastic, so I think this business can do well for a long time.
All right, so that's one you like.
Yeah.
Let's talk about one you don't like so much. You would avoid Fiserv. Now, this one's interesting, because this one's been shelled this year.
Yeah.
It is down.
I don't want to pile on.
About 70%. Sometimes analysts, guys in the street will say, okay, well.
Now it's time to buy.
Listen, how much worse could it get?
Yeah.
You say not so fast. Let's go through the reasons why. One, weak earnings report.
Well, this is sort of why we're here right now, right? Is because they came out with the earnings report that was sort of shocking. Sometimes you see an EPS miss of like a cent or 2 cents and the stock will get punished 10%. These Fiserv missed by, I think, 25% on the EPS result, and took down guidance for the whole year from something like $10 per share down to like $8 per share. So that's pretty significant for a business of this size to say we're going to earn 20% less this year than we thought we were going to. So that, I think, led to the rest of the kind of cascade that happened where folks start to lose confidence that they can actually grow the business, do estimating correctly, and they've had a management change recently, which is something else we'll get to in a second.
All right, second reason you would say avoid this one, potential loss of client interest?
So this is, the weak earnings were really a testament to the fact that their products in the market are old and antiquated. Fiserv is a very, very large business, a massive company that's the underpinnings of a lot of the fintech world. However, it's not a household name that you and I necessarily interact with because it powers other things. For example, Clover, which is a point of sale system that they operate, they may have seen at convenience stores and what have you. It's losing market share to folks like Stripe and Shopify and Square and others. So their products are kind of been Frankenstein together from acquisitions and everything they've built, legacy systems, but the whole is not working well in terms of customers feeling like they're innovating. I think folks are moving off Fiserv products to other things.
All right, the third and final reason you'd say, you know what, not in my portfolio, mood that there may be other shoes to drop. What's going on there?
We're seeing some, Senate investigation into the former CEO who then moved on from the company to go to the IRS and the Social Security Administration. He had some government deals that were in process, so the Senate's investigating whether there was some conflict of interest that were not disclosed. And so there's a question about, have we really learned everything that's happened here, or are there going to be other things that we're going to be finding out about in the coming weeks and months? And so for those reasons, I think it's one to kind of just step back from and avoid as an investment.
All right, we're going to end here, though. How could you be wrong about this one?
Well, I mean, the reverse case of SoFi, right? This is one that's already had a big move to the downside. It is a massive, massive company that's very much ingrained in a bunch of the financial services that we look at in our daily lives. So, there is a stickiness to this company. It's not going away. But I do feel like it's sort of had a really loss of confidence, both in terms of the market and investors and customers.
All right, leave it there. Buy SoFi, avoid Fiserv. Cameron, always great to see you, especially in person.
Thank you. Good to see you.
Thank you, sir.
Tiger 21 is a private invite-only networking group for ultra-high net worth individuals, and it releases quarterly reports on where its members are holding their assets. According to the third quarter data, members are putting their cash to work, favoring private equity, and they're also increasing their crypto holdings. Here to talk more about the report, Michael Sonnenfeldt, Tiger 21 founder and chairman. Thank you so much for being here.
Thank you.
This is a fascinating group of folks, and it's interesting to learn where they're putting their money. And it sounds like they're taking on risk, or at least they didn't in the third quarter. So why do you think they're doing that, and how did it manifest itself?
Well, first of all, we have a risk-on portfolio across our 1,700 members, $250 billion. 79% is split between private equity, that's the first at 30%, public equity at 23%, and real estate at 26%. So long term, that's pretty bullish. But one of the things that's going on is crypto has recently doubled over the last year from about 1% to 2%. That may not seem like a lot, but when you're talking about 250 billion, that's $5 billion of crypto. And in every meeting, people are talking about, is this a new security asset? Will this be a safe haven like gold? And so in our meetings across the globe, people are really comparing notes on, it's not so much crypto, it's mostly Bitcoin, but not exclusively. Obviously, we have some of the great crypto traders, and they go into all the other varieties of digital currency, but Bitcoin is the big kahuna.
Have there been any other interesting changes over the past several years besides that sort of increase in interest in crypto?
Sure. The long-term biggest change is private equity moving from 10% to 30% over a decade. So that's the biggest systemic change. The other one is that hedge funds used to be about 6-7%. They're now 2%. Hedge funds are basically dead as a doornail. And that's mostly because our members have learned that hedge funds on average, particularly those investing in public stocks, have a hard time beating the averages, and they cost a lot more. So you're better off in the index funds. Fixed income, quite low. And as I say, crypto coming up a little. That's the one that, even though it's only 2%, that's the most talked about asset right now.
And do they see those returns as better in private equity? Because that stuff has high fees as well.
Well, our members are not going into the mega funds. They're both going into smaller mid-cap funds and making direct investments. When you're some of the world's greatest entrepreneurs, already they're 1 in 10,000 by accomplishment. They can roll up their shirt sleeves, they can look at a building, they can buy a building directly, they can look at a small company. They want to be on the board of a small company where they're the first to hear about a problem so they can help solve it, not the last. When you're a public stockholder, you're the last to hear about a problem, and then it's too late.
Right. And we were talking a little bit during the break, and I think what is notable about these folks, I think people watching, they always want to know how people make their money because they want to make money also. What's interesting here is even though these people are building onto their wealth by investing, many of them, as you told me, that's not how they sort of initiated their great wealth build, right?
So we are a particular group. We're all entrepreneurs who have mostly had a liquidity event. The great wealth in America is created by entrepreneurs, not by investors. When you've created wealth, you want to preserve it, and therefore you become an investor. But the rates of return you'd have to earn to become a Tiger member, as an example, over a 20 or 30-year period would be over 20%, even more than Warren Buffett. But nobody can sustain it for as long as he did. But 5, 10, 20 years, you can build an extraordinary amount of money. Once you have that much money, you want to become more conservative because you want to preserve it. And now you're earning lower rates of return, but with much less risk.
So when we're talking about things like we're watching in the market, and we're talking about all the time about is AI in a bubble, have some of these tech valuations gotten overextended? When you talk to your members, what are you hearing from them about that?
You know, we have groups, 60 across North America, 60 cities. We're about 100 groups across North America. You meet every month and you say, what happened in the last month that was most important? And these are all peers, so they're not selling, they're helping each other. What's going on in the markets is they're saying, where are things going? But let's not overreact in the moment. We're not day traders. We're people who are investing for 10 and 20 years. In order to create wealth, you've had to be investing for 20 years if you're building a company. It's not a day trader's market. So our members are predisposed to long-term investments. And that's why I say when we're 79% long invested, that's a midterm bet, not a bet about whether the market will go up or down in the next day or two.
And so that would imply that they are seeing value in some of these longer term AI infrastructure build out projects.
Absolutely. Well, depending on where you think AI is going, you have all of the equipment, you have the chip manufacturers, not just NVIDIA, maybe Micron is undervalued, but then you have all the energy providers. So there's a long chain of investments that you could make if you're a believer in AI.
Michael, I'm curious, is there, what's the sort of age dispersion among your members? And is there also a difference in how they're approaching all of this?
There is. It's a great question because a decade, maybe 2 decades ago, we're now 26 years, our average age was around 59. Today it's closer to 51. And what does that mean? It means that you can, in a global economy, a frictionless economy, particularly with the internet, you can grow great wealth in a much shorter period of time. So 20 years ago when you joined Tiger 21, you had finished your wealth building days and now you had to build a business over 20 years, now you're going to retire. Today you can create that wealth if you're really lucky in 5 or 10 years, and you might be 40 years old, and you're going to do it again and again. So 20 years ago, our members were thinking of themselves as passive investors. Our members now, after they sell a business, are thinking of doing it again.
Wow. Okay. So is there a piece of advice that you would give people who are watching who want to emulate some of these folks in terms of building those businesses?
It's all about the basics. You know, if you get distracted by momentum and all of these stories, the story stocks, but if you want to know basics, you know, you can make an extraordinary amount of money owning a Dunkin' Donuts or any of the franchises, Wendy's or, you know, whichever the quick service restaurants are. It's slow and steady. Some people think it's like watching the paint dry, but over the long period of time, you can really create great wealth, which with less risk if you're a terrific entrepreneur. It's not so easy to do.
Yeah, Michael, great to see you. Thanks for coming in.
Thank you.
Appreciate it. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets as we continue to see this sell-off here, and the sell-off gaining steam to the downside. The Dow right now off 640 points, about 1.4%. The S&P off 1.25%, and the Nasdaq down 1.8%. As we do see the sell-off in tech in particular deepening. We should say, though, even with the recent sell-off, the Mag 7 ETF is still up 16% this year. Names like NVIDIA and Microsoft have climbed some 40 and 50%. So investors' 401ks may be rising, but our next guest says that might be in contrast to their sentiment. Wall Street Journal chief economics commentator Greg Ip writes in a column today that AI is ushering in the most joyless tech revolution ever. And he's joining me right now. Greg, it's great to see you.
Thanks, Julie.
This has been something I've been trying to ask investors about, that, yeah, your portfolio's going like gangbusters, but if you talk to people on the street, if you talk to your friends about how they feel about AI, the answer is not great. So how should investors be thinking about that sort of disconnect?
Well, this is an issue principally, Julie, about ordinary Americans, not necessarily investors. Look, if you happen to be one of those lucky few who has a 401k chock full of Mag 7 stocks and you've had them there for several years, you're feeling pretty good, financially secure. But if you're in your 20s or your 30s and you're trying to think of your career, you know, you have a degree in one of the sort of the standard kind of like professional areas like computer science or finance, you're really wondering, is there going to be a career for me? Is this technology going to take my career paths away from me? Or alternatively, maybe you just don't understand the technology very well. Why does it give me the answers that it gives me? And it's sort of like feels a little eerie. So I guess what I'm saying here is that we can all sort of like identify how transformative this tech is and why it could be great for the economy in the end. But I think a lot of people just are very wary of it and uncomfortable with it. And by the way, this is a big contrast to a generation ago. People felt much better about the dot-com boom at that time.
Well, I want to dig into that a little bit, because I think that whenever one expresses skepticism about AI and how ultimately helpful it might be, the answer is, oh, well, in every innovation cycle, you get this sort of hand-wringing and questions about it. But as you just pointed out, that's not necessarily the case.
No, I think that's true. And people are always ambivalent about technology, right? I mean, with the internet originally, Andy, they worried about their privacy. With social media, they worried about their kids getting cyberbullied. With computers, a lot of people worried about losing their jobs. So the fact that a new technology provokes these mixed feelings, there's nothing new about that. And it may, in the end, be the case with AI as well. Perhaps in a few years' time, when more people have had a chance to use it and some of the apocalyptic scenarios have not come to pass, people will feel better about it. But right now, that's not the case. And it is in contrast to how most of these other technologies have evolved over the last 25 years. And I think it's a kind of a warning sign for society at large, basically, because I think that this is one piece of the many things that are bothering people right now. It's like if they felt better about the cost of living, maybe AI wouldn't bother them so much. But given that they're bothered by so many other things right now, it just feels like another thing compounding their insecurity.
And by the way, Greg, all of those examples you just mentioned, those things did happen. In other words, with the internet, we did lose our privacy. With social media, our kids did get cyberbullied and other terrible things have happened. So in other words, people's worst fears in many cases were realized, but we just sort of move forward anyway. So I guess in this case, the question is, are we going to listen to those lessons of yesteryear and regulate AI in a different way? It doesn't feel like we're going to.
Yeah, and I would also, again, I started my career covering the dot-com boom, and the feel was very different. That one, it was almost like an adventure, right? I mean, everybody knew somebody who was quitting their job to go start a dot-com business, right? And it had kind of an absurd feel to it. I mean, some of us remember things like the sock puppet mascot for pets.com and so on. So we all kind of understood there was an absurdity to it, but it was kind of an exciting and playfulness to it. And that feeling to me is completely absent today. The companies that are building upon AI, profiting from AI, they're not these scrappy little startups. They're massive, incredibly wealthy companies like Microsoft and NVIDIA that a lot of people are already kind of suspicious about. Like startups like OpenAI seem very kind of like distant and detached from ordinary people. So the entire kind of like atmosphere around AI is quite different. And if I'm in the AI industry, I would want to not ignore that, right? And in my column, I point out the example of nuclear power. I mean, if you go back to the 50s and the 60s, everybody said this is going to be transformative. It will give us electricity that is so plentiful that it's too cheap to meter. But eventually we had the 3 Mile Island accident, and people were never really comfortable with it. And nuclear kind of like ground to a halt. And right now, if you look at the surveys, people, even though, as you were saying, they get that this technology is useful, like other technologies have been useful, they want to see it regulated more. And they are very untrusting of this industry vis-a-vis other industries.
So from an economics perspective then, how do we think about the potential of AI if there is this sort of sentiment issue with it?
I don't really know. I mean, I quote in my column a couple of studies that talk about extreme scenarios where there really are no humans necessary except for tiny portions of economic activity. I mean, that's pretty dystopian. And it's probably not the base case. I mean, there will be disruption, but it won't be like, you know, the movie WALL-E where everybody's living in space and being, you know, fed by robots. Mm-hmm. So I think that in time, the sell-off we're experiencing right now, in fact, might be one sort of like returning to Earth phase for this industry, and people will feel better about it. But I also think that it probably behooves society at large to think hard about how this technology is affecting people's expectations for the future, and to realize that in an environment where people are very mistrusting of a lot of things out there, is you don't want to sort of like make this a reason to be even more mistrustful.
Greg, great to talk to you. Thank you so much for joining us.
Thanks for having me.
Thanks. Well, President Trump is hosting Saudi Arabia's Crown Prince Mohammed bin Salman at the White House. In focus, everything from defense to artificial intelligence chips. Yahoo Finance's Jennifer Schonberg is standing by at the White House with more on this. Hi, Jen.
Good morning, Julie. Saudi Arabia's Crown Prince Mohammed bin Salman expected to arrive at the White House on the South Lawn shortly in what is expected to be a welcoming ceremony filled with pomp and circumstance. We are keeping our eye out for an official military flyover. We also expect military bands to accompany his arrival as well. This will be the Crown Prince's first visit in 7 years to the White House. And this visit is being billed as the sequel to President Trump's trip back in May to the kingdom, in which he secured $600 billion in investment from the Saudis in the U.S. And that pact spans defense to energy, artificial intelligence, advanced technology. And one thing that we're looking for today is more specificity on those targeted investments within that $600 billion commitment. We are expected to have that announcement this afternoon. Additionally, we're expected to see an agreement signed on securing critical minerals, an agreement between both countries to secure that supply chain as the U.S. looks to diversify away from China. This is day one in the Crown Prince's visit. Tomorrow, both the president and the Crown Prince will participate in a business forum at the Kennedy Center with dozens of CEOs. So we will await what types of new announcements we could see. The last time the president was in Saudi Arabia meeting, we saw announcements from Oracle to Uber saying that they would invest in both countries. Back to you.
Jen, thanks very much. Appreciate it. Coming up, we're taking a look at some of today's trending tickers. That is next on Market Catalysts. Now time for some of today's trending tickers. We are watching Baidu and PDD, Amer Sports, and Barrick. First up, Baidu and PDD. China's internet search leader Baidu posting its worst sales fall on record. Meanwhile, PDD, the owner of Temu, warned on revenue growth. Joining us for more, Yahoo Finance's Brooke DePalma. But Baidu shares are up, which is interesting.
Yeah, and what we're seeing is that this company, ahead of this report, the shares were up about 30% year to date. And what we're seeing is that the company did beat on when it came to revenue, about 31.1 as opposed to 30.7. So just a slight beat there. But now we are seeing some momentum in this early morning right now. But PDD, a different story there. That stock falling based upon this warning, ultimately, that they have this tough China consumer landscape will ultimately play into the rest of the year. And so a bit of a different story that we're seeing back and forth, but both of these companies have had lots of momentum heading into these results, both up more than 30%.
Yeah, and I'm just looking at PDD is up this year. Baidu is up like 36% this year. So they have done pretty darn well. Let's talk about Amer Sports too. It's raising its full year guidance for the third time this year as strong demand for its Salomon footwear. Salomon drove third quarter sales to record. It occurs to me I've seen Salomon boots many times. I've even bought them, and I don't know the right way to say them.
I believe it's Salomon.
Yeah, I don't know.
What I will say is
they're
that
good boots.
It's good boots, high price boots.
Yeah.
And that's the key price point here, or a key opportunity within this market, is this luxury premium market continuing to do well. We saw it with On Running as well just last week. It's this niche within this market where consumers are pulling back, but yet the premium market, those high income earners are continuing to spend. And that's what really spoke volumes in this quarter. We are seeing the stock move higher this morning, up more than 7%, nearly 8%. And what the CEO and executive said on the call is that their specialized, highly technical brand serves the premium sports and outdoor market, and that continues to be one of the healthiest segments across the global consumer landscape. And so clearly they're in the right spot right now within this. Also, that Salomon footwear, they said that it has a very strong demand and it still has a small share in the market. So that's perhaps why we haven't seen it too much yet.
I remember when these guys went public, it was just last year. Wow, yeah. Just last year at the end of January.
Known really for that Arc'teryx brand.
Yeah.
Big coats.
Oh, they own that one too. Okay. Well, they came public at $13 a share, and now they're trading at around 33. So not so bad there. And finally, Barrick, activist investor Elliott Management. Man, they are busy. They've reportedly taken a large stake in the miner. That's according to the Financial Times. Those shares are up about 1.3%.
Yeah, and what we know is that they recently announced, or Barrick announced, that it's considering a split between its Africa and North America business. Now, Elliott apparently has a holding of about $1 billion, I read. And so really, Elliott, like you said, has been quite busy. We just heard earlier this year, they took that stake within PepsiCo, and they really demanded there a clear path to better performing and higher valued PepsiCo through greater focus. And so really this company looking also, or rather this hedge fund looking to also get a stake stake here within Barrick Mining. This company has had quite a tear as well. It's up more than 140% year to date, but some are arguing that the company hasn't benefited as maybe as well as others within the space, and so really looking to capitalize further on this rally that we've seen in gold year to date.
Yeah, we'll see what they end up doing, if anything, amidst this pressure. Thanks so much.
Also,
Brooke.
Starbucks, they got involved last year, and that really turned the tide for them too.
Yeah, so we'll see what happens with Barrick. Thank you. Coming up, why a record number of home builders cut prices in November and what that means for the sector going forward. Home builder confidence ticked up 1 point in November with a reading of 38, but any reading under 50 suggests more builders view conditions as poor than good. And notably, 41% of home builders noted they offered discounts in November, the highest reading post-pandemic. For more, Jim Tobin, National Association of Home Builders CEO, is joining me now. Good to see you, Jim.
Morning, Julie.
Seems like an increase of a point, still not great. And I'm just curious how you would characterize things overall.
Well, we had a nice jump in last month, and so to see us kind of stay up at that level is good news. I was worried that we may retrench a little bit, but 1 point gain again, given the uncertainty that's out there, whether it's the unemployment numbers or the lack of unemployment numbers, the government shutdown, where is the Fed going to go next month? So I think this is as good a sign as we're going to get. The market continues to be soft. When I talk to builders in all different markets across the country, the word I get is soft.
And as a result, and in reaction to that, they're cutting their prices. I guess the question is it working?
It is working. They've got to eat through the inventory that they have sitting on the ground right now. So I believe it is working. Again, talking to many builders, I'm at our fall leadership meeting here in Denver, Colorado, and a lot of members are seeing people come through the model homes, and they are responding to some of those price cuts as well as mortgage rate buy down. So the incentives are working. We just need to kind of accelerate through the existing inventory and then lead us into 2026, where we can put more building on or more homes in the ground next year.
Jim, I talked yesterday to Meredith Whitney, longtime housing analyst, and I want to play for you what she had to say in terms of what needs to change to really inflect in the housing market.
There are more buyers than sellers right now, and so that means that home prices are going to be higher for longer. And then, of course, rates coming down by at least 100 basis points. That would be, I'm going back to when the last time the housing market was hot was 2020, very early 2021, and rates were lower and home prices were a lot lower. So even if you had a medium correction in home prices of 10%, that would help a little bit.
So obviously she's not just talking about new homes, right? She's talking about the housing market overall, but we are pretty far away from another 100 basis points down in rates and a 10% cut in prices. Do you agree that that's the kind of dramatic move that needs to happen to really sort of unstick things in the housing market?
I don't know if we need as dramatic a movement as she's suggesting. I don't see, we're hovering right about 6.1% for a 30-year fixed rate mortgage. Low fives, that sounds great to me, but I think anything that gets below 6, consistently, and we stay in that space for a little while, I think that's good news. Is people are certainly buying down into the 5s anyway through some of these incentives. And so again, if we have to wait till we get to 5%, I think that's a much longer road. But I believe that if you are a creditworthy borrower, and now is the time to go. You can't time the market. I think anybody that thinks they can do that is going to miss any kind of opportunities out there. That's number one. Number two, we do have to change the mindset of not only buyers but sellers out there that we are not going back to 3% or 4% mortgages. That is a break glass moment, whether it's after the Great Recession or after the COVID pandemic. Those days aren't going to come back. So I think it's just really kind of socializing this feeling that rates in the 5s are where we're going to settle eventually, but don't time the market. Get in there now. We just have to have confidence that it's okay, and that's what we're lacking right now. I think buyer confidence is the biggest factor right now.
And in what sense? You think that buyers are not confident right now?
I think the economy feels Yeah, I think the buyers aren't going to enter into the single biggest transaction they make in their lives, whether it's another home or their first-time home. They don't feel settled, right? Unemployment's up. We still have some unsettled business with the federal government. I think that the economy feels funky, and that is a technical term, funky. And so that is what I think is keeping buyers on the sidelines right now. They need more confidence that the economy is headed in the right direction before they're going to enter into it. So they're going to sit on the sidelines right now, coupled with all of those sellers that are sitting rate locked. That is the issue that the whole market is facing right now.
And Jim, we've talked about this before, but I wonder if your members are kind of getting creamed on margins. If they're continuing to offer these incentives, they're continuing to cut price. By the way, they still are constrained by tariffs in terms of costs, some of their input costs. So not surprising that their sentiment, while it may have improved from the lows, is still not great.
It's still not great. Again, the whole economy feels a little bit, like you said, slow at the moment. But you're absolutely right. I think that there really is this feeling out there that we've got to get over this hump. I think 2026 is going to be better than 2025. And I expect builder sentiment to improve as we move forward. But you're absolutely right that builders have to feel better about things. And while tariffs have not been the big drag that we thought they would be earlier in the cycle, but land prices are still high. It's still difficult to get through your permitting process at the local level of government. So it's still difficult to build, and they are seeing their margins erode as they try to move the product that's already on the ground.
Yeah. Jim, good to see you. Thanks for joining us.
Thank you.
Well, Yahoo Finance Invest highlighted some of the top leaders in AI and crypto last week. Here's a look at some of the biggest moments from the event.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America and quite frankly all over the world. People who have like normal means who are now rich because of Poundgy.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
The economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
Government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule.
Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention.
We make an investment, and the management team, the day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done faster than they would have done.
Most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about making sure that they're launching products. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base.
We're mining Bitcoin for roughly 50 cents on the dollar every single day, 24 hours a day. We're mining Bitcoin and we're adding it, and we believe this asset's going to be transformational. Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control. We can't do business like that. We need more, from our government leaders.
Coming up, we'll get a little stock market 101 from Jared Blickery on how to short a stock in today's Stocks in Translation. We'll be right back. Eric Trump, co-founder and chief strategy officer of American Bitcoin, and the company's executive chairman, Janut joined Yahoo Finance Invest to talk about the business behind Bitcoin and where the industry goes next. Here's part of that interview.
We mine Bitcoin so cheaply because we've got cheap energy. And by the way, isn't it nice to be able to do that in the United States of America where we actually have favorable energy policy? We haven't had that for a very long time. You see it with oil and gas and everything else coming down to record lows right now. It's a beautiful thing to see. America has to lead the way. Energy cost is everything. Energy cost is directly correlated with GDP. The lower the energy you have, the higher your GDP, and that's what we want for this country. So we're doing it in West Texas using some of the lowest energy costs. Brian, we're mining Bitcoin for roughly 50 cents on the dollar to the average, to the spot price of BTC. Every single day, 24 hours a day, we're mining Bitcoin and we're adding it. And we believe this asset's going to be transformational. Listen, a little while ago, I looked at the exact price of Bitcoin 2 years ago from today. You know what it was? It was 36,500, and now it's sitting at 105, 104, bouncing around. It was up past 120 a month ago. Bitcoin has been one of the greatest assets of our time, and even now as you see volatility, which you always see in cryptocurrency, because naturally a slightly higher vol. We're still 170, 180, 190% higher than we were at this exact date 2 years ago. And I think that speaks to the fact that everybody around the world wants it. Every Fortune 500 company is putting it on their balance sheet. Every family office is buying more and more. People are hoarding it. And this isn't just in the United States. This is all around the world. It's an incredibly exciting asset class. And I believe in Bitcoin with every aspect of my heart and soul.
Eric, you know everybody in this industry, of course. Earlier on, we kicked off our conference with Michael Saylor, aka the Bitcoin King. He really made a strong case that more companies need to have Bitcoin on their balance sheets. Do you have Bitcoin on the balance sheet of the Trump organization? And if not, why not?
We have a ton of it on the balance sheet. I'm incredibly proud of that. I've got a ton of it on my own personal balance sheet. And obviously I'm going all in terms of American Bitcoin. I mean, we're setting up the greatest Bitcoin company in America, listed on the NASDAQ, ABTC, using Hut 8's infrastructure. Asher is one of the best people in energy anywhere in the country, anywhere in the world. And we're mining it, as I said before, for roughly 50 cents on the dollar. There is no one doing it that's better than us. There's no one that's doing it with more passion than us. There's no one who's doing it quicker than us. Listen, we've been listed for under 3 months at this point. And every single day, it seems like we're passing another company. And these are major companies that you know about. And so we're climbing that ladder very, very quickly. And again, our success thus far is beyond incredible.
Asher, let me get you into this conversation. Just before we came on, we had Mark Palmer really make a strong, bullish case for your company and what you're doing. For those not familiar, where is your infrastructure situated? And then day to day, what do your operations do?
We run sites all across North America. We have sites in Texas, we have sites in New York, we have sites across Alberta and across all of North America. Our sites are split up in power generation, so we own power plants, and also data center capacities. Data centers that power Bitcoin and the network that everyone relies on in order to securitize Bitcoin, the asset, and then also sites that we're building data centers for that are powering AI use cases as well. We're a believer at Hut that energy is the fuel that powers all future technologies, and we want to be in the center of technology and power.
Asher, you're building a pretty substantial site, I believe, in Louisiana. Do you have a tenant for that yet?
We have not announced the tenant for that yet, but as everyone knows, power is extremely scarce right now. It's a really large campus in Louisiana with near-term power. And so we'll share more about who's going to go there in short order, but we've already started moving ground, construction on the site, and building a lot of the electrical infrastructure.
Meta's nearby, Asher. Is it Meta? I have to ask.
We haven't shared who it is, and we will soon.
Fair enough. Look through, seen through your prism. We've been talking all day long about an AI bubble. Is that talk ridiculous?
I think in any large-scale wave and systematic shift, you're going to see building. And I think people are saying, how much money is going into this infrastructure? Our belief is AI is going to fundamentally change the way that we operate in the world, the way that normal people transact, how they transport themselves from location to location, how they work in the workplace, at home. And so we think AI is just at its beginning innings of its impact on the world and on society. And in order for that impact to happen, we need to build data centers to power that compute. And so the question is, are there too many data centers being built? Are there use cases already happening? people need to invest today for where the future is going. And so we think we're still at the beginning of that investment cycle and that integration into what AI is actually going to do for the average person.
Are there too many data centers being built?
We have not enough data centers being built. We need more power generation in the US, we need more transmission, and we need more data center capacity.
Eric, let me get back to you here. How do you see crypto changing the future of financial services industry?
Well, first of all, I think it's going to onboard trillions of dollars into the U.S., right? That's happening every single day. You know, no country wants their own home currency other than obviously the U.S. dollar. No one wants a euro. No one wants the pound. No one wants, any of the Asian currencies. Guess what they want? They want the U.S. dollar, and so you have stable coins every day that are bringing trillions of dollars every year. That's bringing trillions of dollars onto American shores. You're going to see more and more of that happening. Second of all, the speed of finance is going to go up. There's not going to be waiting, 36 hours, 48 hours over the course of a weekend to be able to send out a wire transfer. That's going to become instantaneous. Fees are going to go down. Convenience is going to go massively up. So much of the blockchain technology is going to tokenize assets. We're seeing that every day. In fact, some of our buildings are being tokenized for the first time. And I think you're going to have this major shift to Bitcoin as truly the digital gold. I mean, I think you're seeing more and more money that will ultimately come out of gold, and you're going to see that ratio disproportionately shift into Bitcoin because it's been the single greatest asset that we've seen, and it solves a lot of the problems that physical gold has, including weight and transferability and so many other things, right? The ability to monetize, speed of monetization, and so again, you're going to see crypto literally change every aspect of our financial system, and it couldn't come quickly enough. I think we're wholly behind. The banks have been antiquated for too long. The banks have frankly been the monopolies that actually have been a disservice to ordinary people who don't have maybe the Trump last name and don't have a lot of zeros on their balance sheet, who get zero advantage and have been put at actually a massive disadvantage. And there's no question that every single day you see another widget popping up on your Amazon cart being able to transact in either Bitcoin or stablecoin. Crypto is here to stay. Crypto is the future of finance. And American Bitcoin, in terms of what we're doing, being able to mine it cheaper than virtually anyone, we are going to lead the way. We are going to lead the way, and America is going to lead the way, which makes me incredibly happy as a person who loves that flag right behind my shoulder.
It's nearly winter, but the bears are not hibernating just yet. They are out playing in the markets, making their presence known. So it's fitting that on today's Stocks in Translation, we are taking a look at short interest. And when we talk about shorting, that just means someone has borrowed a stock from someone who owns it so that they can sell it first, hoping it will decline. And later on, they're going to buy it back, which is also called covering the short. Now, market regulators require bi-monthly reports from brokers that identify shorting activity, and there's a 1 to 2 week delay, but they can still be very useful. And the key statistic to look out for is the short interest. That's the number of shares that investors have borrowed and sold short, and it comes as a percentage of the shares available to trade. Another step that you want to keep track of is the short interest ratio, also called days to cover. Now, we recently sat down with editor-in-chief of Investopedia, Caleb Silver, in an episode of Stocks in Translation, who explained it.
When you look at short interest, you want to look at how many shares are being shorted relative to the overall share count, right? You want to look at what they call the short interest ratio, how many days to cover.
It is a number that tells you how many days it would take, in theory, for all the shorts to buy back and cover their positions. A higher number means a lot of shorts. But on the flip side, it also means there is a higher chance that the shorts get caught in a squeeze. More on that in a minute. For now, let's take a look at the Wi-Fi Interactive here. And I got all of these stocks, by the way, using the Yahoo Finance short screener on our website, also available on our app. And here I decided to only look at the top 20 companies that had at least $100 million in market cap, so nothing too small. One of the stocks Caleb was looking at is Jack in the Box, and we can see that right here. And Caleb had this to say.
So that's a stock that investors have been betting against, which makes me sad because my grandfather used to take me to Jack in the Box when we were running errands around Southern California back in the 70s.
Personal feelings aside, it's worthwhile going over some of the stats on our site. Turns out there are nearly 5 million shares sold short in Jack, and that number is up about 500,000 from the prior month. And to put all this in context, that means over 1/3 of the tradable shares are currently sold short. That translates to nearly 4 days to cover all those shorts based on recent trading volumes. So it's not surprising that Jack is down about 65% this year alone. Now here's Caleb weighing in on the bear case, also the bull case.
If you looked into the fundamentals of Jack in the Box, not great right now either, but the fact that there's so much pessimism around it, it's a good flag for retail investors whenever they're considering buying a single stock.
And as Caleb notes, even if you're a bull, it can really help to get up to speed on the short interest stats, because that can be the fuel for the next leg up, what we call a short squeeze. And here's Caleb one more time, recollecting the GameStop and Reddit surge that we saw in the early pandemic.
Can I bring you back a few years to 2021?
Yeah,
that
the
was the
GameStop
game,
phenomenon.
right? The more the short interest, the more that big institutions and hedge funds were betting against these stocks, the more that retail investors, especially in meme stock land, were squeezing these stocks by buying them and encouraging others to buy them, setting the price higher, and that makes the people that owned it, that were shorting it, have to pay up those shares that they bought.
And buy they did, in what would be a recurring theme for years. So here we have a quick recap on how you can use short steps. For the bear case, high short interest can flag trouble. Sometimes you'll even see short interest climb before bad news becomes public, so it's very useful information. And heavy short interest can also signal an end to a rally, but there's no magic formula. Stocks can rally for long periods amid growing short interest, which brings up the bull case here, because all those shorts can be fuel for rallies, and shrinking short interest can help confirm turns, with a delay, of course, of about 1 week or two. Now, there's always nuance here, but check out the Yahoo Finance short screener and start keeping an eye on how some of the most heavily shorted stocks are performing under different market conditions. And before you know it, you'll start noticing some tradable patterns. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Microsoft is adding more AI capabilities to some of its most popular services and platforms. And our tech editor, Dan Howley, is joining me now with a closer look. The shares are down because, well, almost everything's down with tech today. On that level, but what do they come out with?
Yeah, they're adding their Copilot to their Microsoft 365, spreading it out more, right? It was already available, but now they're adding more capabilities. They're also adding some back-end capabilities that allow companies to control how AI agents are used inside their organizations and how different Copilots interact with them. So really, this is about them continuing to monetize their AI capabilities across some of their most important products, which is their productivity suite, Microsoft 365, which has changed names over the years. Right. You know, it was Office, it was Microsoft Office, so now it's Microsoft 365, and so that includes everything from Word to Excel to PowerPoint and Teams, and so on and so forth. And so it really is about ensuring that they have the AI capabilities in there that companies can then go ahead and use. And I think Microsoft said something like 90% of the Fortune 500 companies are using its software at this point. How many of those companies have large contracts, though? That's the bigger question. But right. I do think it's just worth noting that they have that kind of interest from these kinds of customers.
And that kind of reach, yeah. I'm just curious, Dan, obviously you haven't had a chance to play with all the things they came out with today, but in your work, across all of, whether it's Microsoft, whether it's Gemini, like how are you finding these kinds of tools most useful?
I think, I've gotten to play with some of Microsoft's tools when it comes to Excel, which is, might as well be like taking a math test for me. Never understood Excel, don't understand it, refuse to try to understand it, but I've seen how you can actually use Copilot to basically make it work for even, a dum-dum like me. And ditto with something like PowerPoint, which just reminds me of doing, projects in high school. Yeah. So if
it's like supercharged Clippy.
It is. And so funny enough, they have a kind of mascot for Copilot called Miko, which is an anthropomorphic version of Copilot that you can talk to and it will talk back to you. And it's like they've referenced Clippy multiple times. Clippy went from hated to kind of a folk hero now.
Yes, we have retro, nostalgia goes a long way, I guess.
Not the 90s.
And then the other thing, Microsoft was busy today because they also came out with an announcement, not with OpenAI for once, but with Anthropic, that they are going to invest some money in Anthropic.
Yeah.
NVIDIA is going to invest some money in Anthropic.
Yeah.
And Anthropic is going to then also contract cloud services from Microsoft.
That old big wheel, it just keeps going around. Yeah, they're going to get $30 billion of Azure compute out of Anthropic. And so, they were previously working with Amazon, previously working with Google. Now they're working with Microsoft. Microsoft says that they're going to use NVIDIA's chips. That's where NVIDIA comes in. And as a result, Microsoft says that they're going to invest $5 billion in Anthropic. NVIDIA is going to invest $10 billion in Anthropic. And so now we have all three cloud providers funding this one company. Amazon has money in it. Google has money in it. A few weeks back, they had talked about how both companies are going to be using 1 million of their AI accelerators to power Anthropic. And so, it seems to be the one that's getting the most play, or almost the one that's most agnostic. But, we have NVIDIA earnings tomorrow. Everyone's talking about overbuilding. There's been this discussion about this cyclical kind of investment trend that we've seen. And this just doesn't really help that kind of, fear, because it's literally what everyone's talking about. So, but it is, it's another player in the space that's not OpenAI. It's Microsoft expanding beyond OpenAI, right? Their agreement now says that they're not necessarily as tied to each other as they once were. And so it's interesting to see Microsoft kind of stretching out to, arguably its biggest competitor, OpenAI's biggest competitor. Got to say OpenAI is also kind of treading in Microsoft's waters, trying to get some productivity software out there. So it's a friendly competition between two buddies, I guess.
I guess. They're all putting eggs in all kinds of different baskets.
Yeah.
Dan, thank you very much.
For
Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming your way next.